So I want to thank you to all of you for coming out today. Today we are on session 2 of Understanding the Numbers. I know that some of you are brand new to this. You were not with us last week. That is totally fine. This is additional or different information that I think you're going to find very interesting. We are going to dive deep into our financial statements. We're going to look at the balance sheet and look at it in detail. We're also going to take a look at the income statement and the cash flow statement. But before we get started, I have a question for you. And anyone that has a microphone, feel free to speak up or use the chat here. But why did the solitary great white shark choose finance? Why did the solitary great white shark choose finance? People are thinking he was a loan shark. There we got some people that say, oh, okay. Okay, again, welcome. I did send some attachments to you via email. Hopefully you all received those. If you didn't, we can send them back out after the training. Might be able to get them off to you during the training. Just let us know if you didn't get the email with the attachments this morning. One of the attachments was a terminology summary dealing with accounting. So dealing with the balance sheet, dealing with the income statement. Those documents may be useful for you today, definitely useful for you going into the future when you are doing your bookkeeping. Sometimes when we're doing our bookkeeping, we have to think of an account name to put our maybe like our expenses under, and so we can come up with this name, but sometimes we choose the wrong type of account. So we're going to talk about that today, but that cheat sheet that I sent you, I do believe will be useful for you in the future to make those decisions. Also, I attached with that email a document that was about 11 or 12 pages long. We're going to see each of the items that I attached to the email in the PowerPoint that we're going to look at. However, if you printed this off, then you'll have it in a much larger format, easier possibly for you to look at. And then also people will ask about the PowerPoint presentation. Yes, you will receive that. And you will receive a video recording of this as well by the end of the week, I would say. So as we get started, my name is Corey Riley. I am with Penn West Clarion University Small Business Development Center. I've been with the SBDC now for almost 18 years. I'm also a small business owner. I tell you that because I want you to know that I'm in the trenches with you. I understand what you're going through. And as you may bounce questions off of me here today, utilizing the chat feature, hopefully I'll be able to answer those questions either from the theory standpoint or from, hey, I'm in there with you. I understand what you're going through. As we get started here, I just want to tell you a little bit about the purpose of this workshop here is that we're going to increase our understanding of accounting. We're going to look at those financial statements. We're going to touch upon financial analysis at the end, although in my mind, everything we're talking about deals with financial analysis because we're getting to know our books. And so at the end, we're going to take a look at the horizontal analysis and the vertical analysis and how you can use that in your business. But first off, a little bit about the SBDC. Now, some of you that have been to our webinars before, you've probably heard this again. Doesn't hurt to just drill it in a little bit more so that you have a good understanding, and so that if you're the business owner, you'll reach out to us and utilize our services. If you are an employee of the business, you can definitely relay this information along to the owner of the business, and they'll give you 5 stars for helping them out. So 3 main things that the SBDC does. One is we offer consulting services. Our consulting services are one-on-one, and we will meet with you either by telephone, by Zoom, or even in person. And all of our services are offered at no charge, and what we learn about you is confidential. So we're not going to go out on the streets and tell people all about your business in a confidential manner there. We also offer training webinars and seminars in person and online. Most of them are offered at no cost, but sometimes there is a fee involved. Normally when there's a fee involved, it's because we're trying to recover some costs that we are incurring based on that particular training. We also offer lots of tools and resources at all of our SBDCs. Industry and market research is like #1 for our clients. And if you're like a business that sells to other businesses, we have a database that basically has like every business in the country. Not every, but probably close to it. And so we can obtain that information, pass it off to you, and you can use it as a tool, an Excel spreadsheet, as a tool to reach out to potential customers that you could sell your product or service to. In a little more detail, the SBDC services that we offer are listed there. As you look down through there, I want you to think to yourself, if I have a business related question, who can I reach out to obtain more information? That's the SBDC. We help businesses of all types. Basically, if you have 500 less than 500 employees, we can help you. And so around here, well, my part of Pennsylvania is pretty rural. We have some larger businesses. Now, some of you are across the state of Pennsylvania, so you might be in the city and so forth. So there is like that little couple of thresholds, but most businesses, if you think of them as small, we can help them out with that. So you see the list of services that we can offer. Our training seminars and webinars, you'll see a list there as well that's offered across the state of Pennsylvania. Again, most of them offered at no charge. And at the end of this training, you will receive a survey, and that's an opportunity to let us know what type of training that you are interested in so that we can try to provide you with what your needs are. Our particular website is at the bottom of your screen there, clarion.edu/SBDC. But here in a moment, I'm going to show you all the SBDCs across the state of Pennsylvania. So if you do a Google search for your particular SBDC, you can find their local training as well. And then finally, the Pennsylvania SBDC, the website's pasbdc.org. And you can go onto that website and find all SBDC trainings across the state of Pennsylvania, all in one location. We do have some special programs. This one here I want to tell you about is called the EMAP, or Environmental Management Assistance Program. So basically every business here is regulated most likely by the government dealing with environmental issues in some way or another. The EMAP program is a part of the SBDC, still offered to you at no charge, and they can work with you, making sure that you are in compliance with all regulations that may affect you. And if there are applications, they can help you find those applications, and they can even sometimes help you fill out those applications or calculate certain numbers that you might need for that application. Again, offered at no cost, confidential. The website and the phone number there is on your screen. Again, you'll get this as a PDF by the end of this week. A couple other programs that we offer that I'm going to have a slide for is if you are looking to sell to the government or looking to sell internationally, we have programs for that also. And if you're also someone that has a new product and you need assistance getting that new product to the market, we have a program for that as well. This next one's a very interesting one as well. So if you are an employer, so you have employees, then you can check into the WEDNET PA program, and we have Jeannie here at our SBDC that can help you at Penn West Clarion, and the website is listed there. But if you have employees, you can obtain training at your choice at your location or somewhere else outside your location, and you can receive up to $2,000 reimbursement for that particular employee that's obtaining the training. Now, there are eligibility criteria, so the best thing to do is to go to the website, and there will be a button on there where you can type in your business information, and they will be able to determine if you're eligible or not for this particular program. But definitely look into it. Who would want to pass up some money to help train our employees today? Here's a map of the state of Pennsylvania, and on the right-hand side is a list of SBDC. So if you're not in our territory, take a look at this and find the SBDC that is for your particular county. Now, I'm from number 7, Penn West University here in Clarion, and you'll see our footprint there in light blue. But again, you're from all over the state, so locate your local SBDC. If you're not already working with them, have a conversation with them, learn how we can help you. A lot of times it just takes that conversation to determine how we can cater our services to you, because we do offer so many different services. Now, as we are about ready to get into this training and dive deep into this, again, if you have any questions, please use the chat option and type your question in there. I'm watching it constantly. Plus, Cindy Nellis is also watching it as well. So one of us will take care of any issues or questions that you might have. We have plenty of time to go through this material, so please do answer or ask your questions. So, question is, why financial statements? What is the importance of financial statements? Well, financial statements is the result of our business and the result of our bookkeeping. Accounting is how we track our revenue and our expenses and our balance sheet items. And it's basically the language of our business. So many of you, if I assume that you're all business owners, you know how to do the work that you do. Whether you are an accountant, an attorney, whether you have a beauty salon, whether you are an auto mechanic, you know how to do that work. Sometimes it's this office work that we're not too sure about. And so today I hope to help you gain more of an understanding into the language of business or accounting. So another item with the financial statements is that once you're done with your bookkeeping and you create these financial statements, it gives you an opportunity to analyze your business and determine how are you doing? How are you doing this year? Maybe compare yourself to the previous year. Maybe look at the economy or look at things that are happening in the world and ask yourself, how are you doing and what can I do to get through this period of time? I've heard from different types of businesses that when it becomes election year for a president, that business slows down because people are unsure what's going to happen, and so they get scared and they quit spending a lot of money. So something you need to ask yourself is, during that year when you see sales starting to go down, what can you do to increase your sales? And at the same time, on the flip side, you might have to look at your expenses and be like, what can I slow down on spending so that I can ultimately have a bottom line that is better. So there are 3 primary financial statements. Now, this webinar is going to hopefully have some back and forth between me and between you. You can unmute yourself and talk to us all. You can use the chat option also to answer the questions that I'm going to pose to you. So as an example right now, can somebody tell me what are the 3 primary financial statements? At least the 3 that I'm going to talk about. You have to read my brain maybe a little bit. But if you are using a bookkeeping system, what type of financial statements would you look at and that you think all businesses would look at? Okay, one person says the income statement. Good. I'll abbreviate that as IS. 2 more. Okay, there we go. There we go. People are talking now. This is what I like. Okay. Yes. So what I see here, and if you're looking at the chat as well, you will see that the income statement, also someone called it a P&L, and then also the cash flow statement or the statement of cash flow, and the balance sheet. So all 3 of those we're going to look at today. Now, before we move on, and because you answered the question, somebody said P&L. Have you ever thought about the name P&L or profit and loss statement? When you look at your tax return at the end of the year, or when you look at the income statement or the P&L at the end of the year, have you ever had a profit and a loss at the same time in your business? You never have. You either have a profit or a loss. It's one or the other. However, QuickBooks, I do believe, is who coined the name P&L, profit and loss. At least, everyone that uses QuickBooks, that's the name that we use now. We rarely use the word income statement, although that is the official name for it. So these are the three statements we will be looking at today. So then let's talk about the balance sheet. What type of accounts are included in a balance sheet? I'm looking for three main accounts, types of accounts that we will see in a balance sheet. Chat with me or use or unmute yourself and feel free to talk. Okay, somebody's saying assets. There we go. We got liabilities. And we got equity. I'll say owner's equity. Sometimes people say net worth. Okay, wonderful. Those are the three main type of accounts that are included in the balance sheet. Appreciate that. So then the next thing is the accounting equation. What you'll see here on the screen, the accounting equation. If you were with us in session 1, we talked about this also, just kind of a review right now. The accounting equation is total assets will equal total liabilities and owner's equity. And if you recall from session 1, I drew a balance sheet similar, something like this. And I said the assets were on the left-hand side with dollar amounts. And then the liabilities and the owner's equity would be on the right-hand side with a list of those and their dollar amounts. And they must equal themselves. I didn't want to put it through that line there. You should be able to see the red ink that I'm putting on the screen there, but they will equal themselves. Assets must equal liabilities and owner's equity. Now, the next thing you see here is how to find your owner's equity or your net worth. And if you recall from basic algebra in like junior high school or elementary or something, I don't know about elementary, but definitely junior high and up, we learned how to move something from one side of the equal sign to the other side of the equal sign. So what you now see here is total assets minus the total liability. So it's a positive on the one side, we flip it over, it has to become a negative on the other side. So if we take our total assets minus our total liabilities, that will equal our owner's equity or our business worth. Now, the balance sheet is also called a statement of financial position. The balance sheet is the only statement that we're looking at today that is dated as of a particular point in time. So if I'm looking at a balance sheet, it will have one specific date on it, whatever date that is I choose, versus when we look at the income statement or the cash flow statement, that is always for a period of time. So sometimes I like to relate your taxes to this because you all see your taxes. Maybe you're new to this bookkeeping thing, but you've seen your taxes before. So your taxes is for a period of time. And most of us, it's for a calendar year, January to December. So in this case of an income statement, it covers a period of time from January to December. Versus the balance sheet will be for one specific date, and that might be, say, December 31st, 2022. What you see here is a sample of part of the balance sheet, and that is something that I did email you. So if you printed them, you will have a full screen, a full page of the next 2 slides. This is what you see on your screens, only half of this page right now. Okay, so what we see here is a balance sheet. This is a balance sheet very, very similar to what the Small Business Development Center at Penn West Clarion would assist you with. And as you look at the date there, I mentioned how it's for one particular date and time, December 31st. Okay, and in this case here, we've done 3 years worth of balance sheets. Now we're going to look at each of these accounts here, shortly, but right now, just kind of getting an overview. Notice that the total assets Okay, the gray areas, total current assets, total fixed assets, total other assets will add up to the 84,085. Then when I go to this next slide, you'll notice down here there's 84,085. That's because the balance sheet, the current or all assets, all total assets must equal our total liabilities and equity. So then also what you see on this particular slide, or again on that first page of the attachment that I sent you, you'll see that there are current liabilities, long-term liabilities, and your equity. Now, just one thing I want to point out to you as you're looking at a balance sheet, because maybe you've looked at these before, and so something I just want to point out is something that flows from one year to the next will be your total, will be your total equity. This 16,776, that is this information added and subtracted. It then goes over to the next year. And so this is how your balance sheet items, how this carries over from one year to the next is through your equity account. So let's talk about assets. Assets are things that we own. They can be physical in nature, or they may be intangible in nature, meaning we can't necessarily touch them, but we own it and it's of value. Okay, they are resources for our business. Think about all the things you own in your business. They are used to generate income in one way or the other. So they are a resource for your business. So the question I have for you is, what are some examples of current assets? Current assets are items that are assumed to be consumed within 12 months, that can be converted into cash fairly quickly within a 1-year time frame. Any ideas of what some current assets might be? Okay, I have somebody here saying supplies. Good. Vehicle, okay, inventory, I see, good. Vehicles, I'm not going to put in here right now. We're going to talk about that later on. The laptop printer, I think we're going to talk about that later on as well. Gift certificates, that's one I did not expect to see. Although I'd have to look into that one. I know I've done research on it. I have it saved, but there is a point where I think, yes, we might see that as a current asset, but also as a liability, something that has to be paid. Material, I'm going to put that in with our inventory. The building, I'm going to keep that. I'm not going to talk about that right now, because those are the vehicles, the laptop printer, and the building is going to be more like a fixed asset. Okay, good. And then also accounts receivables. One other that I did not see is something that is already cash. So that is like your checking account, your savings account, your investments, as somebody just put on there. Thank you. Appreciate that, Michael. So yes, these are some examples of current assets. One other that you see listed there is number 4, are prepaid expenses. If you were with us in session 1, you'll remember that we talked about prepaid rent, prepaid insurance as well, different types of what normally we think of as expenses, but if we're prepaying them into the longer term future, then we have to turn it into a current asset. Wonderful. Thank you for your participation. I will be asking for more of this. Now let's talk about fixed assets. So we had somebody already said a building, and then I gotta find my mouse here. We had someone say a vehicle and a laptop and a printer. So a fixed asset is an asset that is assumed to be consumed beyond 12 months. It has a life longer than 12 months. It's something that would take more time to turn into cash. You know, if you own a $50,000 piece of equipment for your manufacturing business, you can't just sit it outside along the road and sell it for $50,000 and expect someone to stop by in a snap to buy it. Okay, it's harder to sell something like that. So, the examples that you gave are the different types of fixed assets. Now, there are non-current assets as well, which are long-term in nature. Take, for example, a liquor license as an intangible asset that has a long life to it. Goodwill, if you're buying a business and you have goodwill as an asset, that has a long life to it as well. So those are different types of fixed and non-current assets. Someone also mentioned accumulated depreciation. Thank you again. That is something that, and we'll talk about that here in a little bit, and that shows up on the balance sheet under the fixed assets as well. So that is perfect. Let me see if there we go. So there you'll see a list of fixed assets. Some more that we didn't talk about is like furniture and fixtures, our machinery, and then also leasehold improvements can be fixed assets as well. The intangible assets, I guess I skipped ahead and talked about that already. You know, something again that has value, but you can't necessarily touch it. Some examples here, your liquor license. Oh, a non-compete clause also has a longer life to it. Goodwill we discussed, and then these other items, your copyrights, your patents, and your trademarks. Those things all have value as well for your business. Okay, so we talked about the basics of a balance sheet, but I want to dive even deeper in a couple different accounts within the balance sheet. So you're going to have to take a deep breath as we dive into this information for the balance sheet. And the first one that we're going to look at is inventory. Inventory is are the items that you buy from a seller, from a vendor, and then you're going to resell it. Okay, if you're a manufacturer, there are three main types of inventory. There's the raw material that you get from your supplier. You then take that raw material and you start to blend together different pieces of raw material, and it turns into work in process because it's not yet done. And then once you continue with that work in process, it gets to a point where it's a finished good. And that finished good, you're either retail selling it or you're wholesaling it to somebody. If you're a retailer and you buy the inventory from your vendor, it's already a finished product that you're going to then possibly set on your shelf, and you're going to sell it to a particular customer. Now, something of question that people have asked in the past is about consignment. Okay, consignment is not considered your physical inventory. It is something that is still owned by the person that has brought the product to your location to be consigned and sold. So how do you value inventory? Now, this is different for someone that might be a manufacturer versus someone that is solely a retailer. Okay, but some items that go into valuing the cost of your inventory would include like freight and insurance that's involved in that transit, any taxes that you might have paid, any handling and packaging costs, as well as any discounts and returns and allowances for that package or that amount of inventory that you purchased. Think about it this way. When you buy inventory, what is the cost that was all involved in obtaining that inventory? You want to make sure that you get reimbursed for it, right? So that's why you're going to sell it for more than what you have paid for it and paid for it to come to your location. You've got to make sure you charge enough. And so that's why you're going to include all of that in the valuation of your inventory. Now, there are two different ways of tracking your inventory. At the bottom of the screen there, you'll see one is perpetual, one is periodic. We're going to take a look at each of those. So periodic inventory tracking, it's the most basic level of tracking your inventory. If you don't have a bookkeeping system where you input inventory into it, like your purchases and when you receive your inventory and when you pay for your inventory, if you don't have a bookkeeping system like that, you most likely are using the periodic inventory system. So what's going to happen is you're going to track all of your purchases through the year. Somehow you do it either on a piece of paper or a spreadsheet. That you're just going to put in all of your purchases that you make. And then at the end of a period, sometimes for us small businesses, it's just at the end of the year, not every day, not the end of the month, just at the end of the year. We're going to go out, we're going to count our physical inventory. You can use some sort of worksheet or Excel spreadsheet that you've created, that you would go out and you would see, you'd have a list of everything that you normally have as inventory, and you would write down how much of it you currently have. Okay. Then once you know all of your purchases that you made throughout the year, which you do, on a sheet of paper, and after you go out and count all of your inventory at the end of the year, you can then calculate your cost of goods sold. So now I'm going to put you to the test. I'm looking for an equation from you. How do you calculate your cost of goods sold based on the information that I just gave to you? And if it helps, I put in parentheses, think of what you might see on your tax return if you've ever looked at that part of your tax return as a small business. And if you look at your tax return, whether you're a sole proprietorship, partnership, LLC, S corporation, this calculation all looks the same on your tax return. So does anybody know this particular equation? Okay, nobody's answering. I'm sure you're thinking it through. So the first thing that we need to know is our beginning inventory. Okay, Rich is giving us some input here. That's absolutely right. So we're going to start out with our beginning inventory. We're then going to take into account our purchases. And along with our purchases, as Robin's also mentioning as well, we may have other materials and other labor that we can include into our into this equation. What I would call, and we're going to talk about this here in more detail, but our direct labor and our direct materials that go into play with our inventory. Robin answering this and Rich answering it very well. They may be manufacturers, because that's where we see that a lot of times. So you have beginning inventory plus your purchases minus your ending inventory, and that will give you your cost of goods sold. That's the most basic level. Okay, it can get more detailed than that. And we'll look at this equation again later on when we are looking at direct material and direct labor. The other type of inventory system is our perpetual inventory system. This one's more complicated, more expensive. Normally, it means you have a bookkeeping system. So if you're using a program such as QuickBooks that is allowing you to order inventory through that bookkeeping system, or maybe not like literally ordering it, but actually, or just recording the ordering of it in that bookkeeping system, and it allows you to receive the inventory that you ordered, and it allows you to enter a bill against that inventory, then you are using a perpetual inventory system style. Okay. So there's no temporary purchase account like just a piece of paper on the side. There's nothing like that, like we just talked about. This is literally done in each and every purchase right in QuickBooks, right in your bookkeeping system, and that bookkeeping system is making calculations automatically for you. Now, you don't necessarily have to do an ending inventory, although I would suggest that you do an ending inventory still. Even our biggest stores around, like walk into a Walmart and they're still doing physical inventories. And our large manufacturers all around us here are still doing physical inventories. So, and the reason for that is you need to reconcile that which is in your physical location as compared to what is in your bookkeeping, and make sure that they agree with you at the end of the year. So the reason why you would count your inventory at the end of the year is for the reasons at the bottom of your screen. They come up missing sometimes. That's called theft. Either your employees are taking it or the business owner is taking it. Now, you might not think of that as theft, okay, because it's the owner taking those items, but at the same time, if they're just freely taking it and then you have to make an adjustment in your bookkeeping, which affects your taxes, it's still missing according to the government, so it's still theft. Also, if you're like in the food industry or something, you have spoilage and then of course breakage, different parts and pieces and items that you sell get broken. So those are reasons why you want to do that physical inventory count at the end of the year to find out what is still good on your property. So the way that you're going to value your inventory through the perpetual system is through either first in, first out, or last in, first out. Now, first in, first out I think is probably the way that most small businesses would do this. Your bookkeeping system doesn't necessarily use FIFO, and it actually doesn't even use LIFO. If you have a bookkeeping system that's really expensive, a special manufacturing bookkeeping system or something, then they can use FIFO and LIFO, but take like example like QuickBooks, it doesn't, and I'll talk about that here in just a moment. Okay, so with FIFO, the first inventory that you order is considered the first inventory that you sell. So first in with your inventory, first out with your inventory. The balance sheet in a bookkeeping system normally values an approximate current cost when it comes to using FIFO. The matching of revenue with the expense of your cost of goods sold through FIFO is not the best match. If you recall when we talked in session 1, if you were with us, and we talked about the accrual basis of accounting. There, if you earned your income this month, and with LIFO, which offers a better matching, if you had the most recent inventory that you ordered being sold with that revenue, it would be a better match because the cost of your last in inventory is at the current cost of today, versus FIFO, first in inventory, is the first to go out. That some of that inventory could be aged depending on your type of business, and if it's an aged inventory, then it is most likely at a lower cost than what you're buying inventory for today. Let me see here. Okay, so on this slide here is where I want to talk about the average cost with you, but let's look at these examples for first in, first out, last in, first out. Sorry, I think I said that wrong earlier, but last in, first out, LIFO, and then this average cost thing. So if you ordered 3 items of inventory, and in order of when you purchased them, the first one that you purchased was $100. The second one was $300, and the third one was $500. And now you've sold 2 of those items. With first in, first out, you would have sold the $100 item and the $300 item because those were the first things you ordered. So they're going to be the first things to be costed, expensed out of your business. And so your ending inventory, or the EI, as you see on your screen here, would be $500. So if I had to do a balance sheet today, which I told you is on a specific date and time, your inventory on that balance sheet would be $500. Now, under last in, first out, or LIFO, the last items that we purchased, the $300 and the $500, they were the last items we purchased. So they are the first items to go out or to be expensed out of our business. Therefore, if we do a balance sheet today, our ending inventory will be the what's left over, of course, right? But in this example, it would be the oldest item we ordered, which is the $100 item. Now, the average cost, this is what a lot of basic bookkeeping systems use. And even QuickBooks, if you still use QuickBooks, it's a very, to me, it's a very robust bookkeeping system. A lot of us only use a portion of what it provides to us, but it still is not strong enough at using like QuickBooks Pro or QuickBooks Premier to do the FIFO and the LIFO. So what it does is the average cost. It takes all of your inventory purchases over time and it averages them all out. And whatever that average works out to be for that particular piece of inventory, that becomes the average cost that gets expensed on your financial statements. So in this case here, you add those three items together, comes to $900, divide it by 3. The average cost is $300. Therefore, your cost of goods sold is going to be those two items that we sold in the example up above there, times the average cost of $300. That's what gets expensed on your tax return, but on your P&L, okay, on your profit and loss statement or on your income statement. Total of $600. Your ending inventory is the one item that's left over times the average cost, or $300 is your inventory that shows up on your balance sheet. So the COGS, cost of goods sold, shows up on your income statement. The EI, or ending inventory, shows up on your balance sheet. Again, if you have any questions, feel free to chat. Even you can turn off your microphone if you want and ask your question there as well. I'll be glad to pause for you. So now that we've talked about inventory and we talked about inventory, which is on one side of the balance sheet, we're going to flip to the other side of the balance sheet. No, I'm sorry. Depreciation. No, we're still on the asset side. I'm sorry. We talked about our current asset inventory. Now we're going to move down to the fixed assets. Okay. And the fixed assets and non-current assets, we talked about some of those already, land, building, equipment, furniture, and so forth, as you'll see down through here. Now, land does not get depreciated. Land is a fixed asset, but it's both basically assumed that it's going to increase in value over time. So it's not something that's going to be depreciated, although it can still be on this screen because it is a fixed asset or a non-current asset. So as we dive deeper, we're going to take a look at depreciation and amortization now. So what is depreciation? Depreciation is taking the value of the asset that you purchased, and it's recovering that cost over a period of time. So if you recall, under cash basis accounting in session 1 last week, under cash basis accounting, when you purchased a $10,000 piece of equipment, you would expense that piece of equipment in that year that you purchased that piece of equipment. Because under cash-based accounting, it's cash in, cash out. There are no fixed assets. There are nothing beyond 12 months. Under accrual-based accounting, there is fixed assets and there is depreciation. And so even though you purchased a $10,000 piece of equipment today, you're going to take that cost and you're going to recover it over a number of years. That's what our depreciation is going to be. And then, as someone mentioned earlier, there is accumulated depreciation. Accumulated depreciation is how the depreciation is reported on our tax return or on our balance sheet. I'm giving you some wrong words there. Kind of the same, but different. So we will have what we call depreciation expense. That shows up on our income statement as an expense. Some of you call it a P&L statement. The accumulated depreciation, that is what shows up on our balance sheet, and it subtracts away from our asset. But here's the thing. If you have an asset of that equipment that has a value of $10,000, you're not subtracting away from that number per se. There is this accumulated depreciation account below it that subtracts away. Let me show you, because I don't think I have it in the PowerPoint here. So let me show you. On our balance sheet, you have equipment, $10,000. Then underneath that, you're going to have this account called accumulated depreciation. And it's going to be in parentheses. And let's say that we depreciate this equipment over 10 years, just for even numbers. Then each year we will have a depreciation expense on our income statement, but on our balance sheet, which is what we see on the screen right here, you're going to have a $1,000 contra asset account, or think of it as a subtraction away from this equipment. This equipment on the balance sheet, if you own it for the next 20 years, will still have a value on your balance sheet of $10,000. It's just the accumulated depreciation is going to increase every year. So the next year, it'll say 2,000. The year after that, it'll say 3,000. The year after that, it'll say 4,000. We'll just keep adding to that accumulated depreciation. Now, I won't get too picky, but when it comes time to sell it, okay, or too detailed, I don't want to lose you too much here. When you go to sell this piece of equipment, if it says 10,000 and if it says 3,000, and yet if you sell it for 9,000, if we take 10 minus 3, that equals 7,000. You're going to have to pay capital gains on the difference between 9,000 and the 7,000. Okay. So, assets that you own in your business, those are the things that can be depreciated. The IRS has a useful life for all types of fixed assets. And the way that you depreciate it is, it can be different between your business and the government. So your business normally uses straight line depreciation, which is taking the $10,000 and dividing it by a number of years, as I gave you in that example. 10,000 divided by 10 is $1,000, right? So $1,000 a year over the next 10 years. Now, the IRS, they like to make things complicated, right? And nothing is simple with them. So they use these types of modified, accelerated, and I forget what it's called. We'll see it here in a moment. I don't see it on this slide here, but it's a modified way of recovering the cost of your expense. And so take, for example, equipment will be depreciated out over 7 years. If you buy it mid-year, you'll have a mid-year depreciation expense because it's only for a certain amount of time. And then normally when you get into your full years, it goes from higher to lower. So if I gave you an example of maybe $500 depreciation in the first year, that's like a mid-year expense. And then the next year might turn out to be like 3,500. And then the next year, and I'm not adding up these numbers to make sure they work out correctly, but then maybe 2,500 and 1,000. It works its way down to zero. Okay. So somebody is asking, do you have to depreciate? I'm assuming there are benefits, but it sounds like there are drawbacks. You have to expense these items in one way or the other. If you operate under accrual-based, or even what we talked about in session 1, which was the modified cash basis of accounting, which most closely resembles tax-based accounting, then you can't write off that $10,000 piece of equipment the year that you buy it. You have to spread it out over a number of years. It's basically the way you have to do it. It's the government, okay? The rules by which you have to follow by. And so if you're under accrual-based accounting and level in session 1, I talked to you about GAAP, generally accepted accounting principles. So you may have to follow GAAP, which also requires you to depreciate the assets. So in your general bookkeeping system, no, you don't necessarily have to. But on your tax return, yes, you do. And under accrual-based accounting, yes, you do. So then the one other thing I want to tell you about this is if you're doing your general bookkeeping accounting, this straight line depreciation is totally fine to do it in your book, in your own books, however you do your bookkeeping, like with QuickBooks or FreshBooks or something like that. The other way that you can do it that I've seen a lot of businesses do is they wait until their tax return is done. Say this year, right now, 2023, they're waiting till their tax return is done. When it's done, they ask their accountant to give them what they call a depreciation schedule. That depreciation schedule has a list of all of their assets that the business owns. It has their cost, it has the purchase date, and then over to the right-hand side, it has what their current depreciation is for that year that was just finished, which is 2022. So then they'll take this depreciation schedule and they'll actually go back to December 31st, 2022, and they'll enter in the depreciation expenses that are on that schedule. They'll enter that into their bookkeeping system. So that's another way to input your depreciation. Great question. So here are the useful lives that the IRS normally uses for assets: 5 years, 17 years, 15 years, 27.5, and 39 years. Those are the most common. You can kind of take a look at the particular assets that are depreciated there. Again, land is not depreciated. And the great thing about this webinar is when it's all done by the end of the week, we will send you these PowerPoint slides. So you'll have this for your own information. And you need this information. If you're putting this information into your bookkeeping system, you'll need to know how long should I depreciate something for. Now, you might buy something and be like, where does it fit into what you've provided me? Sometimes you just have to guess at it and I mean, I think this is, for me, it's pretty logical. For you, it might not be. So you look at it, you try to say, okay, I bought this, so it maybe fits into here. Now, if you buy something that's really off the wall and it doesn't seem to fit into there, then yes, you might want to ask your SBDC consultant or your accountant for some input on it as well, because there are some things outside of what I'm giving you, but this is what's most popular. Okay, so here is the makers: modified accelerated cost recovery system. As I said, nothing's ever easy with the IRS. There also is bonus depreciation and Section 179 deduction or election. And these two items can allow you to write off more in that first year, that mid-year depreciation, sometimes even write it off 100%, depending on the asset. Okay, your accountant is who normally worries about this, not you. Your accountant will look at all, your tax return as a whole and determine whether you need to or should write off a new piece of equipment or a new fixed asset that you purchased in full this year, or just maybe a whole bunch this year, but not all of it, or just take the normal depreciation that's calculated by the IRS. So if I go back a slide here, these items right here normally can be written off 100% or a greater percentage with that Section 179 or even that bonus depreciation. These ones, I don't believe so. I'd have to look into that one. And then these two here definitely are no's. They cannot receive accelerated depreciation or additional bonus depreciation. So someone's asking, let me see here. So what if I know it is not going to last that long? So if it's an asset that is going to have a life less than 12 months, then it's not a fixed asset, so it wouldn't be depreciated. It would be a current asset. So just remember that a fixed asset is an asset that has a useful life more than 12 months. I know sometimes photographers, they go through lenses at least once a year, and those lenses can be really expensive, so they may have a shorter lifespan than 1 year. Also, there's some things that your accountant will help you out with, and for example, there is some de minimis options that you can take advantage of, which means if like one of them is if the invoice of a purchase of an asset is less than $2,000, that one particular invoice, then you can write that off as a general operating expense, okay, as repairs and maintenance or something like that. But that one there, I would definitely talk to your accountant about, let them talk to you one-on-one and give you some more detail on that. Of course, the SBDC can give you details on it and give you stuff to read about it, but they're not going to give you the lowdown on it that yes, you should do this, or no, you shouldn't do it. Great question. Take a breath, everyone. We've been undersea for quite some time. We've been holding our breath with that deep dive into the balance sheet. So you're going to have to take a deep breath, because we're now going to flip over to the other side of the balance sheet, and it's going to be another long one. So here we go. Liabilities on your balance sheet. Liabilities are your debt. Okay. It's the things that you owe money for. There are current liabilities and there are long-term liabilities. Current liabilities are liabilities that are going to be due within 12 months, versus in the next slide, long-term liability will be liabilities that are beyond 12 months. Okay, so let's get you chatting here some more with me. Current liabilities. What's some examples of current liabilities? Debts that are assumed to be paid within 12 months. What can you give me here? Utilities. Payables. Credit cards. I don't think I'm going to put deposits there. I'm not sure what you're thinking, so my mind's not with you right there. So other debts, okay, yep. Sales tax due, good, wonderful. Sales due. Let's go like that. Sales tax due. Apologize about that. I'm just scribbling, but I'm wanting to give you, so that you can follow, stay with me as we're reading through these chats real quickly. So yes, you are absolutely correct with some of these. Accounts payable are something like your utilities. Okay, you accrued the expense of electric over this month here, and so now you get the bill in the mail, and it's going to be due in another 10 or 15 days. So that is something that is payable into the near future. Lines of credit are, think of it like your credit card that you buy things with, and then you have to pay it back with interest. That's what a line of credit is, and it can be in a form of a check or a credit card, different forms for that. Now, lines of credits, I do want to clarify that should mostly be used for maybe inventory purchases, because inventory you hope to turn over fairly quickly, and also or turn it into cash fairly quickly so you can pay it off. And also line of credits for I just drew a blank there. Line of credits for like your other payables, things like that. Okay, things that you're going to pay off fairly quickly. Also, well, the accrued expenses goes along with accounts payable. Deferred revenue goes in there as well. And you all are correct when we talk about sales tax payable. Someone else also put up there insurance payable. Yes, or not insurance payable, but well, that would insurance payables would go in there. Someone's asking about payroll. Absolutely. So you have payroll expenses that need to be paid, such as the wages. Okay, somebody, you have someone work for you for 2 weeks, and so they are accruing a payable that's going to become due in a couple weeks, that you'll have to literally pay them out in a couple weeks. So that's a payable. All of your taxes for payroll are accrued as well over a period of time. Take, for example, your local earned income tax. You accrue that over a quarter. Okay, you withhold it from your employees over a quarter of time, a quarter of a year, and then it becomes due, the following month after that period. So that is a payroll payable as well. Great job. And those are all current because they're all within 12 months. Okay, so our long-term liabilities are debts that are going to be paid beyond 12 months. So when I went back a slide, you will see there's the current amount of long-term debt. Because if you have a loan for 5 years, the first 12 months is a current liability because it's going to be paid within 12 months. And then the loan amount beyond that year and up to that 5-year time frame, that's your long-term liability. So anything due after 1 year. Examples here, we have our mortgages, we have our vehicle loans, our equipment loans, any of those larger loans that's going to be beyond 12 months is a long-term liability. Now, a balance sheet, as we talked about in session 1, a balance sheet, you see it most common when you're using a bookkeeping system such as QuickBooks, FreshBooks, and all the different types out there. There's one out there called Patriot software, I believe, Patriot software or Patriot bookkeeping, and there's multiple out there. If you're doing your bookkeeping by hand, then you may not have this type of spreadsheet where we're talking about current liabilities, long-term liabilities, and even when we're talking about this loan where there's a current portion and a long-term portion, you may not have that on paper or in your basic Excel spreadsheet. So we've talked about assets, we've talked about liabilities, then you have equity. And if you remember in the accounting equation was assets equals liabilities plus owner's equity. So let me just go assets because I'm going to talk about it the other way now. Assets equals liabilities plus owner's equity. So if we want to find out what our equity is worth, and bookkeeping systems do this for us, it takes your assets minus your liabilities to equal your owner's equity. And right above that red there, you'll see different names for it based on your business structure. If you're a sole proprietor, or then you have a capital account. If you're an LLC with one owner, then you're an LLC sole proprietorship. So you use a capital account. But then I should say, when you become the LLC, you become considered a member of the company. So you'll have a capital account, but you're going to put the word member in front of it. Or maybe in the case on a balance sheet, I might call it Riley, that's my last name, Riley Capital. If there's multiple owners or multiple LLC members, then that's where the partner's capital comes into play. So you might have partner 1 capital. You might also call it Riley Capital, as you see up above, and then the other owner maybe is Smith. So then Smith Capital. This is in the case of having multiple owners, your partners. And again, if it's an LLC partnership, it's the same thing. You're called a member, but there's multiple members, so you would have Smith and Riley. And then also we have down at the bottom our shareholders. So if you're like an S corporation, then you're going to be a shareholder of the company. So you would have an account for each shareholder in that business, whether it be 1 or whether it be 2. Okay. So the equity, and we're going to see it here in just a moment on the next slide. Well, let's just go to the next slide. I think it'll be easier to understand it from right here. So if we look at what shows up in the equity account, this is the case of a sole proprietorship. You're going to have the owner's draw. This is the money that you as the owner take out of the business. And you'll see that down below on this balance sheet example. You're going to have the net income from the business. which flows from the P&L or the income statement onto your balance sheet. And then you're going to have the capital. This is the money that goes into the business. And if I go back one slide, that's where you'll see it right here. It indicates that the owner has contributed something to the business, either money or an asset. If you have a fixed asset, like a building valued at $100,000 and you're contributing it to the business, then you have a $100,000 capital account because you've contributed it to the business. So the owner's capital, you'll see here, there's the initial basis of cash or non-cash items that you've contributed. And then the capital account becomes a dollar amount based on over time. And this is something we looked at the beginning, and now we're looking at it once again. You see the arrows at the bottom of the screen, hopefully. And so your total equity account for 1 year is added and subtracted together, and then it flows up to the top of this equity account in the second year. And from there, you then subtract away your draws and you add the net income, which will give you a new equity amount at the end of that second year, which flows up to the third year. Again, a bookkeeping system takes care of this for you, but it's good to understand it because when you print a balance sheet from your bookkeeping system, it's good to understand how and what this information means to you. Now, sole proprietorship, as you see at the bottom of the screen, is going to look just like a partnership right here, except now you have two different owners. You have Doe and you have Smith. And you might see over in this column right here that the numbers are a little bit different. The capital account is 6,000 versus Smith's capital account is 4,000. What we see in the bottom left-hand corner is that Doe owns 60% of the business and Smith owns 40% of the business. So all of this works the same as a sole proprietorship. It's just that we have more than one owner. Now, this capital account over here in the second year, you'll notice at the bottom how it's calculated. We take the net income of $18,776 and we prorate it based on their percentage of ownership, 60% and 40%. That's how we're coming up with these answers right here. And so the 10,000, I'm trying to think of how did I come up with these numbers here? The 10,065.
Corey, it's because they took out more than the withdrawals were higher. Right?
Man, I just calculated this earlier today too. I don't have a calculator handy with me. 618, or no, I think it's this here. It's this right here, sorry. So this 18,776 is how we figure up this, but then to figure out what comes up here, we got to take this 16,776 here, and we got to take it, this should be times the, why am I drawing a blank on this? I think I need to do the 60% and the 40% here as well. Cindy, if you have a calculator, that would be great. I need to bring a calculator with me next time.
Yeah, so the 16,776 multiplied by 60% is 10,065 and the 6710.
Okay, so this is this here, which is going up there, right?
Yep, 60% of 16,776 is 10,1065, and 40% of that is 6,710.
Okay, thank you. So then this calculation down here is determining what share of the net income is your net income for the business. So what's going to happen is this amount here, this prorated income, This is like what you're gonna see as a share of your business on your tax return. But your capital is gonna be based on this, and that's what comes up here at 60% and 40%. Sorry about that. I'm gonna make better notes on that next time. I know I calculated this earlier today when I was doing this. Now, we then have, after the partnership, we have the LLC equity account. The LLC equity account depends on whether there is one owner or multiple owners. So if you're an LLC sole proprietorship, you are back here where it says sole proprietorship. If you are an LLC partnership, then you're going to come back here where it talks about being a partner. Whoops. Sorry about that. And that's how your LLC is going to be figured out. It just follows along with the sole proprietorship or the partnership. Now, the LLC can also be an S corporation. So when we look at that here in just a moment, it would look just like that as well. The main thing is that when you are an LLC, you change your name from being an owner of the business to being a member of the business. So if we now take a look at the S corporation, the S corporation, some of you very well may be, some of you may be C corporations as well. C corporations are normally for larger companies. S corporations are for us small businesses that want to be taxed, want to be treated like a company that has limited liability, and yet we like to be taxed from a personal tax basis. So the S corporation is a mixture between a sole proprietorship and a corporation. And it could also be, if there's multiple owners, an S corporation could be a blend of a partnership and a corporation. And we're not going into great detail on those. If you want to learn more about those business structures, then the seminar or the webinar that SBDCs offer across the state called the First Steps to Starting a Small Business might be a great training for you to learn more about these different types of business structures. Of course, reach out to your local SBDC consultant as well, and we would be glad to dive deep into what your business structure is and whether it might be advantageous for you to evolve into another business structure.
Hey, Corey.
Yes.
Rich has a question.
Oh, okay. So when you say keep separate accounts, how do you list them in the chart of accounts? Are they listed as payroll or are they listed as equity? I'll tell you what, I think here. So if you have your printout, let's see if I can show you something here briefly. If I go, you gotta find where it's at now, though. Just 1 second here. Okay, here we go. You use these things in preparation, but then when it comes time, then you gotta think quickly. It doesn't happen so quickly. Okay, so to answer your question, let me see. I gotta bring up that chat again. When you say you keep separate accounts, how do you list them in the chart of accounts? Are they listed as payroll or are they listed as equity? So in the chart of accounts is going to follow exactly like what we see on a balance sheet. So in this case here, you see these items that are, and I can't write on this right now, you see these things that are current at, am I sharing that with you?
Yeah, we can see it.
Yes, okay. So if it's a current asset or a fixed asset or an other asset, these things are listed in your chart of accounts respectively as these particular type of assets. When you come down here, if in your chart of accounts, it would be listed as a current liability or as a long-term liability, or as owner's equity, depending on the account that you're talking about. Okay, so if you're talking about your capital account, in your chart of accounts, it will be listed as an equity account. Hopefully that answers your question. If not, please let me know. Be glad to help you out some more.
Hey, Corey,
Yes.
we had a comment prior to Rich's about a little bit ago. It was from Julie. I believe she was asking about current liabilities. Would payroll go in current liabilities?
Yeah, I saved it.
Yes, so if your payroll, when you're accumulating that payroll tax, you're withholding it from your employees for a period of time, that's payables, and so that is a current liability. And then and then your wages. So if your employee earns $10 an hour for 8 hours today, you're not paying them today. You're going to pay them like in 2 weeks from now. So that is a payable. That is a current liability. So sometimes we call that payroll, or we call it wages payable. And so that remains on your balance sheet as wages payable, current liability, until you pay it. And then when you pay those wages to your employee on payday, it then moves from wages payable to payroll expense on your P&L. Hopefully that answers your question. Also, that the attachments that I sent you, has examples of balance sheets on there. There are 2 different examples, one for a restaurant and another for a manufacturer. We're going to take a look at those here, I do believe, in a little bit. Let's see here. So with the corporation, whether it's an S Corp or a C Corp, there's going to be common stock involved. So if 2 people own an S corporation, and if it's 50-50, then and let's say maybe the attorney says that there'll be 100 shares of stock for that S corporation. And so if it's 50-50, one shareholder will have 50 stock, and the other shareholder will have the other 50 stock, or any different, any percentage of ownership, 60-40, 70-30, whatever it might be. And then you have this additional paid in capital. This is what the shareholders are contributing to the business. And then you have retained earnings. Think of that. If I go back a slide, I believe I got to get my screen to work again here. If we go back a slide, you'll see here the members' capital. So in the S corporation or C corporation, it's called the retained earnings. That's that equity account that flows from 1 year up to the next year. That's what, and what you see here is that equation, the beginning retained earnings plus your net income for the current year, minus any cash dividends paid out. And that will equal your retained earnings, which will then flow up to the next year. It becomes the beginning retained earnings for the next year. Notice that there are no draws, no owner's draws. A sole proprietorship and a partnership, or an LLC sole or an LLC partnership, they receive draws from the business. Versus an S corporation, the owners of the business have to take a paycheck. So a paycheck doesn't show up in this particular equity section of the balance sheet. So here we go. Here's a slide for the S corporation showing exactly what I talked about. The capital stock is like the initial investment to start the business. The additional paid in capital is anything extra above and beyond that. And then your retained earnings, we calculated from this equation right here. And that equals the 16,776. Now, what you see here is a balance sheet for a very large corporation. Okay, we might recognize this particular corporation, Harley-Davidson. This is public information because they're a public company, so you can go out and find this information. And this is going to be way more difficult than what ours are. But what I'm showing you here is, and as we build upon it, and if you look at the handouts that I gave you, they all look very similar to each other. Now, this one is going to have some accounts that you're probably never going to deal with, such as finance receivables, restricted cash. Some of these, you may not deal with a whole lot in your small business. But these big companies, they have a lot more things that they're dealing with, and they have a lot more employees that they're dealing with as well. But they all follow the same pattern. Here you have current assets all listed down through. Here we have current liabilities listed down through. And then we have our equity. So a large company and a small company, the balance sheet always has assets, always has liabilities, always has equity, no matter the size of your business. Okay, quit holding your breath before you blow up, everybody. I know that was a lot, so.
Okay, Corey, you've got a couple questions.
Okay.
I love your pictures. Okay. Going back to owner's draws, we have a question. Is the owner draw okay for an S corp that is listed as a partnership?
So the way I'm reading that is no. Is an owner's draw keywords there is only for sole proprietorships or partnerships. Unless you're an LLC, then you're an LLC sole proprietorship, LLC partnership, and you take owner's draws. When we flip over into the S corp, the S corp owner must take a paycheck. And the paycheck does not show up in equity. It shows up up above in that payroll payable that I talked about, and it shows up on the income statement as a payroll expense. You might call it a what do we call it as an S corp owner?
A shareholder.
Shareholder pay is what that can show up as. So you might have heard of something, and I'm just trying to read into it. You might have heard of something called distributions. I'll write this on the screen here so that I remember what I'm talking about. You might see a thing called distributions for S corporations, and that's a whole different ball game. The main thing to think about right now is that you have to receive a paycheck. So then the next person says, how do you determine owner's pay for an S corp? Okay, that was a whole bottle thing I wasn't actually going to get into, but here it is. Okay, so how do you determine owner's pay for an S corp? That's a great question. What would you be paid as an employee of your business doing the position that you are being paid for? So if you are going to be the general manager of a restaurant and you're the owner of the business, the shareholder of the business as an S corp, what would you normally pay the general manager in your business? And that's how you can determine how much you should pay yourself. Now, of course, you can pay yourself any amount you want to, as long as the money is there, right? So then we get into this idea of distribution, as you see on the screen there. So if you are with paying yourself a reasonable pay from your S corporation, and so as a general manager, you pay yourself $50,000 for that restaurant. And then on top of that, you need to add to those the responsibility of being an owner of a business. So, maybe dealing with phone calls and emails and paying bills and doing bookkeeping and things like that, whatever else you might be doing for your business. So you might have to add an additional amount to the salary of a general manager that you're paying yourself. And so once you determine what that reasonable pay is, then you would be eligible to take out distributions from your S corporation. And if you take out those distributions will show up in the equity section of your balance sheet. Now that was a deep dive, deeper than I planned on going, but that was a great question that I'm willing to dive deep into. The next question here or comment, let me see, it says, can corporate owners, shareholders, take a distribution or a bonus? So I think I answered your question there. You can take, if you're not paying yourself a reasonable pay, okay, I said general manager, $50,000, add some more to that, maybe another $10,000 to do the work of the owner of the business. So let's say that we figure out your reasonable pay to be $60,000. If you're not paying yourself that much because the money's not there yet, okay, so you're paying yourself only $40,000. Well, that's not reasonable pay according to Department of Labor research that the SBDC can help you out with. And so if at the end of the year, if there is extra money left over and maybe you want to give yourself extra money, maybe like a bonus, okay, as your owner of the business, shareholder of the business, then you're going to have it just like a paycheck. It's going to be a bonus through a paycheck, and you're going to have all the taxes withheld just like you would any other paycheck. You can't have the bonus considered a distribution because you're not yet paying yourself a reasonable pay. Next question, Rich, how difficult is it to switch between being an LLC sole proprietorship to an S Corp or a C Corp? Not real hard. Yeah, it's something that your attorney can help you out with, or the Penn State Entrepreneur Assistance Law Clinic can help you out with that possibly. And SBDC consultants can, of course, give you more insight and talk to you about and talk you through some of this to determine if it's advantageous for you to do so. Okay, and that's a whole nother bucket of worms I could talk about. So it can be done. And as an example, my own business, I started out sole proprietorship, brought in a partner, with a partnership for a little bit, and then evolved into an S corporation partnership. So S corporation with multiple owners is basically what it is. So yes, you can evolve up into these different business structures. Great questions, everybody. I need to take a deep breath now. Okay, so let's hold our breath. We're going to dive into something else, and this time we're going to dive into the income statement. So the income statement, also known as the P&L, the profit and loss statement, it shows what your business is doing over a period of time, such as January through December. It includes your income or revenue or sales and your expenses. So we're completely switching gears now. We're pushing off to the side the balance sheet, which included our assets, liabilities, and owner's equity. And now we're going to talk about our revenue and our expenses. The format is the same for all business types again. So as we go through sole proprietorship, partnership, LLC, S corporation, C corporation, they're all the same. Income minus expenses. Now, there can be some differences in your bookkeeping system versus that which goes on to your tax return. But your accountant can work with that. They use your bookkeeping information to determine what goes on to the tax return. So in front of you, you see the top portion of an income statement for a restaurant. I emailed that to you. It would be page 6 of the document that I sent to you. So if you've printed that off and you want to see the full page of it, you can all at one time. What you'll see here for this restaurant, first off, is take a look at the date. It's for the years ending. Now, this is for the 3 years ending. If you're only doing a 1-year income statement, then it would just say for the year ending December 31st, 2022. And below that, then you see your sales all added together, all the different categories for your sales, minus your cost of goods sold. Again, this is an income statement, similar, extremely similar to what the SBDC at Penn West Clarion would assist you with, is helping you come up with these numbers if you want to do maybe like projections. Okay, and that's more or less what this is. Let's say that we're in, I should have actually changed these dates to be different, but let's say we're in 2019 right now. And we're projecting your revenue and expenses into 2020, 2021, 2022. Okay. So total sales minus your cost of sales is going to give you your gross profit. From your gross profit, then we're going to subtract away all of our operating expenses. Take a gander down through there, all of the different types of expenses that your business can track. And I hear this quite often from business owners or entrepreneurs looking to start a business is how do I know what I can track for my business? You know, ultimately, I look at it this way. If it's a business related expense, it goes on your profit and loss statement or on your income statement, or goes into your bookkeeping, or it goes onto your tax return if it's a business related expense. Now, something I do want to point out to you is this depreciation and amortization. When we talk here in a little bit about the cash flow statement, these two items do not show up on your cash flow statement. And when we get to the cash flow statement, think of it this way: cash flow statement, cash flow, cash in, cash out. You might look at all of these expenses listed here as cash out, but the depreciation and amortization is not cash out. Remember, we talked about depreciation. You buy it this year, and for tax purposes and accrual-based accounting and the mixed, cash accounting, cash-based accounting, you have assets, fixed assets. And so you don't write it off entirely the first year. You're going to recover that expense over multiple years, maybe 7 years. And so you get a depreciation expense or an amortization expense for the next 7 years in your income statement or on your tax return. So when we're talking about a cash flow statement, it's not actually cash moving anywhere. Okay, it's just a recovery of that one purchase. Okay, so anyhow, when you take I went back a slide here. When I take my gross profit minus all of my operating expenses, minus the interest from my commercial bank loan, I'll be left with a profit or a loss at the end of the year. The other thing, while I'm talking about cash flow versus income statement, is the cash flow statement will show my entire loan payment, because that's cash going out of my business, right? So principal and interest is going out of my business. That shows up on the cash flow statement. But in an income statement, the interest only shows up on the income statement. Why not the principal? Because the principal is actually on your balance sheet as a long-term liability. So you're subtracting away from that balance sheet account when you are recording that loan payment. So let's take a look at revenues. Revenues are the things that we sell. It's the dollar amount or the price of the goods or services that we're selling. Okay. Your gross sales is your total sales or your total revenue. However, whatever word you want to use, that is your gross sales. Your net sales, though, is calculated by this equation right here. Take your gross sales minus any discounts that you're offering to your customers, minus any returns that have come back to you, minus any allowances, reduced price due to the problem with a product or service. Subtract those things away from your gross sales, and you'll be left with your net sales. I kind of talked about this already, but when you're recording your revenue, you need to ask yourself from session 1 of this training, are you operating under cash-based accounting? Are you operating under accrual-based accounting? Or the modified, I call this the Frankenstein cash-based method of accounting. So revenue, if you're cash-based accounting, you recognize revenue only when you receive the actual payment, versus accrual-based accounting. You recognize the revenue when you earn it, not necessarily when you get paid for it. Under modified cash-based accounting, it operates for revenue. It operates under cash-based. So if you receive the money, then you actually get to claim it as income at that time, not when you earned it, just when you received the money. Cost of goods sold on your income statement. It's the direct cost to provide the good or the service. It will vary based on your sales because it depends on what you're selling. And as we mentioned earlier with inventory, it depends on the cost of the inventory. It depends on the FIFO or the LIFO, first in, first out, last in, first out, or the average cost, which is what the bookkeeping systems use. Okay. So it depends on the cost of the inventory and what inventory you're actually considering being sold as to what your cost of goods sold will be. So that's why it varies so much. Now here we're talking about the direct materials, direct labor, and your direct overhead expenses. And this is related to manufacturing businesses. And so if you're a manufacturer, I believe you can relate to this. If you're a new manufacturer, then we probably should have more conversation with you about these different direct expenses and how they should be calculated in your cost of goods sold instead of calculated in your normal operating expenses. So the formula for cost of goods sold, we talked about this earlier. You take your beginning inventory, you add your purchases like your direct materials. Also, you may add, if you're a manufacturer, the cost of direct labor and the cost of direct overhead, and then subtract away your ending inventory, and that will give you your cost of goods sold. Your gross profit on your profit or on your income statement. Your gross profit is calculated by taking your total sales divided by your cost of goods sold. That will give you your gross profit. Now, your gross profit can be important when we are looking at benchmarking, when we're comparing you to financial ratio, doing financial ratios and comparing you to other businesses similar to you in the industry, like your competitors, comparing you to them. This number will be important when determining those numbers. Also, for gross profit, it's important to know this for pricing purposes. How should you price your products? So what expenses are allowed on your income statement? I kind of already alluded to this. I jumped ahead. If it's ordinary and necessary for your business, then it is an allowed expense on your bookkeeping, in your bookkeeping system. Okay. What's not allowed on your income statement are owner's withdrawals. Remember, owner's withdrawals or draws, whatever you might want to call it, those are on your balance sheet in the equity account. It affects your equity, your balance sheet, your draws do, and your draws also affect the cash flow statement, which we haven't talked about yet. But your draws do not affect your income statement.
Hey, Corey,
Yes.
would you please address if you have a service business, is there a cost of goods sold?
Okay, so most of the time, no. Most of the time, there will not be a cost of goods sold for a service-related business. And the reason for it, you're not selling inventory. There's no products being sold. Therefore, you would ultimately skip that section. You wouldn't even have that section in the income statement. It would go directly from your sales, and you would subtract away your operating expenses. That part of that part of the income statement wouldn't be there. Thank you. Also, as an allowed expense on your income statement, you're not going to subtract away anything of a personal nature. If you have to question it, it's probably not an allowed expense. Okay, so I hear this different times from people. Can I write off my side-by-side? Okay, that's like an ATV. Can I write off my ATV in my books? And I say, well, what are you using it for in your business? Well, no, nothing really. I just figured I might be able to write it off and put it as an expense on my business. If you're not using it in the business, it's a personal expense then, so you can't write it off. Now, if somebody were to come to me and say, hey, I have a utility side by side, one with a little dump trailer on it, and I use it to haul my tools around. I use it to go back in these back to these camps where I clean chimneys, and I can't get my vehicle back there. So I load up, my side by side with all this stuff, and then I can go back these unplowed driveways back to these camps. Well, then if you're using that side by side for business, it's a business expense, right? So you have to look at it, use your own thoughts on it. If it's personal, it's personal. If it's business, it's business. It's normally, it should be black and white as that. Okay. And then from there, you're the one that's going to decide whether you go gray or not. So these operating expenses of what is allowed, you'll have selling and general and administrative costs of doing business. You have this long list, and we looked at a sample income statement just a few slides ago. These are all things that are necessary for your business, and they're all things that are normal for your business. You have to watch out for that too. The government does look at your type of business and say, is this a normal type of expense? And if it's not, then they can question that. And so again, you ask yourself, is it normal? Is it necessary for my business or not? Other expenses that show up on the income statement, we talked briefly about interest, and also specific taxes are going to show up on your income statement as well. So how do we come up with our profit and our loss? Looking at that example that we looked at earlier, again, it's your gross profit minus your operating expenses is going to give you your income from operations. From there, you're going to subtract away possibly add other income, or subtract away other expenses that aren't, the normal ones you see up above there. And that will give you your net income or your net loss, also called a profit and loss statement. So we talked about other expenses here, which show up as other income right here, or other expenses. But what could be other income? Well, maybe you have a business checking account or a business savings account that draws interest, okay, or accrues interest, and therefore that is a type of other income that would show up on your income statement. So here's the example of the income statement that we just got done looking at several slides ago, but I wanted to throw it up here again now that we've went through the income statement so that you can see these again. Once again, look at the time frame. I think it's important because it's for a period of time versus the balance sheet. The balance sheet would only be using this day right here. It wouldn't be looking at January through December like the income statement does. So again, your sales minus your cost of goods sold is going to equal your gross profit. Take the gross profit minus your operating expenses will give you your income from operations. And then from there, you can subtract away your interest from loans. You might also add savings account interest, which when you net these together, you either have a positive or a negative to add or subtract away from your income from operations, and it'll ultimately give you your profit or your loss, your net income or your net loss at the bottom of the income statement. Are y'all staying there with me? I hope so. So we just finished looking at an income statement for a restaurant. Now, here we have an income statement for a manufacturer. And what I want to point out to you is that it's all the same no matter what type of business structure you are. It takes your sales minus your cost of sales equals your profit, gross profit. And from there, we subtract away our operating expenses in order to get down to our profit or our loss, our net income or our net loss. Now, to go back to what Cindy brought up earlier about a service-based business, if this was a service-based business, then you would take this part out. You would have your total sales, which would be your gross profit also. So let's take this out here as well, because this would be, you'd have, it should be your gross profit. If we leave that there, then let's do that there, right? If we leave that there, then this amount would become 212,500 because we got rid of this amount here. So now you take your total sales or your total gross profit, you subtract away your operating expenses, and you'll come down to your profit or loss. That's how a service-based business will operate. Here, I just wanted to throw this out at you. This is a large company, you know, this is Harley Davidson, okay? Take your revenue minus your costs, okay? And ultimately, you'll come down here to, where did I see it? Down here to net income. This looks a lot different than what yours is going to look like. I don't expect yours to follow along with this. Maybe someday when you aspiring entrepreneurs grow your business from what it is today to a multi-billion-dollar company in sales, then you'll have financial statements that look like this, but your income statement will always be the same. Revenue minus expenses will equal your profit. Okay, moving on to the cash flow statement. You can take a little breath, not a deep breath, to go up, grab a little breath, go back down. Let's talk about the cash flow statement for a couple minutes here as well. So the cash flow statement, if you are based, if you utilize cash-based accounting, like we talked about in session 1, then your income statement is going to look just like your cash flow statement. So let me try to word this a little differently here. If you are operating under, if your business is operating under cash basis accounting, then the two statements look the same. Income statement will look the same as cash flow statement. The reason for that is, I mentioned earlier, the reason for that is you're operating under cash basis accounting, you don't have fixed assets. So you won't have depreciation and amortization, right? Remember, we saw depreciation and amortization on the income statement. Under cash-based accounting, you won't have that. So they're both those statements will be the same. Therefore, under accrual-based accounting or modified cash-based accounting, both of those we talked about in session 1, your income statement and your cash flow statement will look different. The cash flow statement is essentially the same as your checkbook or the same as your bank statement, because you're just thinking about cash coming in, cash going out. That's a basic cash flow statement. So let's compare between a cash flow statement and an income statement. And let's assume that we're operating under accrual-based accounting, and to a point also the modified cash-based accounting. So depreciation and amortization, you have assets is what this is telling me. You own some assets. The cash flow statement, it doesn't show up on there because no cash moves each year that you have depreciation. On the income statement, it does show up. That's where depreciation and amortization will show up, is on the income statement. Your loan payment, I talked about that a little bit ago. The principal and the interest will show up on the cash flow because when you make a loan payment, that includes principal and interest. So that shows up on the cash flow. However, on the income statement, only the interest shows up. When we're talking about our owner's draws for sole proprietorship, partnership, LLC sole, LLC partner, it will be included on the cash flow statement because it's a draw. It affects our balance sheet and our cash flow. It's cash being moved. But the draw does not show up on our income statement because it is not an expense for our business. Owner's draw is not an expense for our business. Accounts receivables. Accounts receivables will show up on the cash flow statement only when the cash is received. Whereas accounts receivables for the income statement will show up when it's earned. The accounts payable follows the same suit as the accounts receivable, basically. The accounts payable, when you actually pay it, you pay out that money, it shows up on the cash flow statement. For the income statement, though, it's going to show up that when it's earned on the balance sheet before it turns into an expense and shows up on the income statement. Inventory. Inventory shows up on the cash flow statement only when you pay for it. However, inventory only shows up on cost of goods sold whenever under accrual base. I told you we're operating under accrual base. When you end up when you end up selling that inventory, I guess is what I'm saying. Under accrual base is going to be when you end up selling it. The cash flow format. There are a couple different formats to the cash flow statement. I like to think of it this way. There's the easy way and the hard way. Okay, the easy way, the SBDC at Penn West Clarion does it what I consider the easy way. Okay, or the direct approach. Okay, but your accountants, and if there's any accountants in the room here today, the accountants normally create the indirect cash flow statement. And really the indirect cash flow statement is the accountant's cash flow statement. It's what you learn in school is the indirect method. But the direct is one that you all easily understand, and I'll show you here in a minute why. Okay, so as you look at the slide there, the indirect method is required for public companies for sure. It starts with net income and it reconciles cash to it. It actually kind of works backwards, and it's definitely more complicated. The direct approach is simple. It looks at what cash came in and what cash went out, and that'll be much more simple to understand. So take a look at a comparison in more detail. On the left-hand side is the indirect method, and on the right-hand side is the direct method. So on the left-hand side, we have our operating cash from our customers that's received and our operating cash that's paid out to our suppliers in and out. Then we have our investments in and out. So purchases or sales of long-term assets and investments in debt or equity of others. It's investments, money coming in, money going out. And then financing, the sale of stock or the proceeds from borrowing, it's money going in, money going out. So 3 different sections of money going in, money going out will result in that ending cash. The method 2, which is the one that's most direct again, if you take a look at those 2 major bullet points, it's all the money coming in all at one time. No, not a bunch of separate sections like on the left. All at one time. On the right-hand side, you have your cash coming in, you have your accounts receivable monies coming in, you have your loan or investing and financing monies coming in, you have your owner investments coming in, and if you're selling any assets, that's money coming in as well. So all of that's just grouped together, its own separate line items, but all on the top half of your piece of paper, if you want to say. And then on the bottom half of your piece of paper will just be all the monies going out, your cost of goods sold, your expenses, your bank payments, again, principal and interest, any purchase of assets, and any payments to your owners. Again, this is like your draws to your sole proprietorships and your partners. So let's take a look at this sample. This would be page 9 in your handout. If you can't see it real well on your screen, then you'd want to look at it on paper. This is the direct method of a cash flow statement. This is the cash flow statement that Penn West Clarion SBDC would assist you with in creating when we're doing financial projections for you. So At the top here, you see cash coming in, cash coming in, cash, all of this cash coming in, giving you total receipts of 210,000. Now this one is really simple, right? We didn't get real complicated on this, but it's your cash coming in. And then we're going to take a look at our cash going out. We're going to start with our inventory purchases. This is cash going out. On the next slide, we see all of these expenses. This is cash going out of our business. We also have these other disbursements. We have our loan payments for the year. We have our owner's withdrawals for the year. We have our asset purchases for the year, all cash going out. And so when we take the amount I circled right here, our cash coming in, minus all of our cash going out, we are left with our net cash flow. And then this down below here, this is just a summary of everything that was above. Our opening cash balance, assuming this was a startup, was 0. And then we have our cash receipts from the previous slide. We subtract away our disbursements, our total disbursements right here, which will then give us our ending cash balance of $12,684. That ending cash balance becomes the cash balance in our balance sheet. This will flow over to our balance sheet to give us our cash balance in our balance sheet. This, so the previous slide would have been for the restaurant, Madison's Tavern. Now this one is for the machine shop, basically just showing you that it is ultimately the same, even for a service-based business, ultimately going to be the same. You have cash coming in down through here. So our total cash receipts at the bottom is $517,750. Subtract away from that all of our cash going out. Now, if you're a service-based business, you're going to get rid of this, right? Remember I said there's no cost of goods sold for a service-based business. So we just get rid of that particular section of the cash flow statement. Everything else going down through is exactly the same. And this bottom line again becomes the cash balance on our balance sheet. Big corporation, going to follow this one. Well, I was going to say going to follow the same format, but I would be incorrect because a big corporation such as this company is publicly traded. And so since it's publicly traded, it's going to have to use the indirect method for its reporting purposes. And so you'll see here, it's a lot different. Okay, we have cash flow from operating activities. We have cash flow from investing activities, and this is in and out for each section. Money going in, money going out for each section. And then our financing activities down below. As a small business, your accountant is going to most likely use the indirect method. So if you don't understand it, of course, ask your accountant or feel free to come to your local SBDC and we'll be glad to look at your indirect method cash flow statement and help explain it to you as well. We're more than glad to help you out with those things. So a summary of understanding financials. Okay, we're getting to the end of this training. I appreciate you all sticking with me, hanging out with me throughout this here. Okay, so in session 1, we talked about a lot of journal entries. If you were with me, we went through a lot of examples trying to help us understand what happens when we're doing our bookkeeping. Okay, especially if we're doing it in a bookkeeping system. Okay, and some people will say, you know, is that really important? Is it really important to know what happens? I think it is. As someone with an accounting background, when I'm helping you answer some question, how do I record this in my bookkeeping system? Right away, I go to what gets debited, what gets credited, what gets increased, what gets decreased. That's what we work through all of session 1 mostly. Okay, and that's what I have to think of when I'm helping you. And therefore, the more understanding you get, the less you might have to rely on me. Now, I love when you rely on the SBDC. And when I say me, I'm talking about the SBDC. I love when you rely on us. But our job is to educate you. And so if we can educate you and you don't have to rely on us so much, then that's okay. We'll help out the next person that needs the assistance. So as you see there, the financial statements is a summary of all those journal entries that you've created throughout the year of your business. It is important to focus on financial accounting, not necessarily tax accounting. Tax accounting is its own, bottle of worms, okay, that you have to open up and deal with. If you think about it from financial accounting standpoint, everything that we've talked about in session 1 and session 2 and anything else that you end up encountering, that's your basic financial accounting. Income, expenses, balance sheets, depreciation, loans, things like that. When it comes to tax accounting, they're going to take what you have provided them, and they may be able to use it in a different way so that you pay the least amount of money to the government in the form of taxes. And depreciation is one of those that I'm thinking of. Okay, depreciation, you might use straight line depreciation in your financial statements. However, the accountant might do it differently in order to give you the best tax advantage this year or years into the future. Okay, so then after you've created your financial statements, that is your income statement, your balance sheet, your cash flow statement, now it's time to do some financial analysis. After you take a breath. Take a breath there for a moment. I don't know about you, but I know when I get to the end of some of these sections, I have to breathe a little bit. It's like, okay, I'm ready to move on to something different. And this guy here was just about ready to pop. So he needed to take a breath. Before we get to the questions on understanding financial statements, everything that we've talked about, I do want to touch upon financial analysis for you, but get your questions thought about. You can definitely be putting them in the chat also, but I don't want to run out of time here. So I do want to talk to you briefly about these financial statement analysis. There is the vertical analysis, which is common sizing your business to be able to compare yourself to the industry. So I might say that when looking at a restaurant and looking at their cost of goods sold, maybe my client has a percentage of cost of goods sold, a percentage of sales of 55%. And I might say, boy, that's really high. As compared to the industry, they're at like 40%. That's like the average. And you're going to be like, well, you can't compare me to them. I'm just a little mom and pop shop. There's no way I can compare to these big restaurants out there. But what common sizing does is it creates these percentages that turn out to be an average compared to the industry. Think about this. If I survey 1,000 restaurants, some will be small, some will be big, right? And once I surveyed all of them and I come up with what the averages are, I'm going from really high to really small mom and pop shop and averaging it in the middle. Now I can take those averages and compare them to you, because you might have even been in that survey for all we know. And that's what common sizing is taking you as compared to the average number that it is for the industry. That's vertical. Now, horizontal is comparing yourself, comparing yourself to yourself 1 year to the next year to see how you're doing. You might ask yourself, it's what, March 22nd. How am I doing this year from January to March 22nd as compared to last year, January 1st to March 22nd? That's what horizontal analysis is comparing yourself 1 year to the next year. Now, if you're using a bookkeeping system, then normally within a few clicks of a button, you can do a horizontal analysis very easily. But that horizontal analysis comparing 1 year to the next year is only as good as you're willing to ask the questions. If you don't have any questions, really means nothing. But if you see things that have changed from 1 year to the next year and you start asking yourself why, now it begins to mean something. So let's think about this. Your sales went down by $50,000 from 1 year to the next. You have to ask yourself why. And some of those reasons might be internal reasons. Some of them may be external reasons. I'm sure you've heard of SWOT analysis at one time, your strengths, weaknesses, opportunities, threats. If you can start to do a SWOT to determine why your sales went down. Maybe you lost a really good salesperson and you haven't been able to find anyone to fill that spot yet. Therefore, maybe that's why your sales has went down. If you understand that, then okay, you at least understand why your sales went down versus saying, I don't know what happened. Maybe it's election year again, or maybe it's the economy, something external to your business. And if you see that your sales are going down because of something external, you should be looking at like that SWOT analysis and asking yourself, what can I do in order to increase my sales? Somebody tell me, what's one of the most common expenses that get cut when your sales go down? People, yeah, that's one. Marketing, advertising, yes, that's the one I'm looking for. People is true as well. I mean, if you don't have the money to keep them on, then okay. But advertising, marketing, yeah, isn't it amazing that if business is getting slower, if you see your sales going down because you're doing some financial analysis, shouldn't you start to market more because you need more sales? Or do you just let the world have its way with you and you just float along and your sales go up and down based on what's happening outside? Now, I say you need to increase your marketing. You need to maybe look at a different way of marketing. Look outside the box, talk to other people, talk to your business consultants and say, ask them if they have any suggestions for you to market your business. And you know, you look at this period of time with the pandemic that we just got out of, and you look at the restaurant industries, and you look at the restaurants that did extraordinarily well. They were the ones that were already takeout. And then they were the restaurants that learned by what was happening quickly, and they made changes. They started offering drive-throughs. I could think of a family restaurant in the town that I live in that, to my knowledge, I don't think they ever had a drive-through, but now they do. And they had it because of what happened. Okay. And I, to this day, still use that drive-through because they offer that now. So, so you need to make adjustments based on the things that are happening in this world. All of your expenses, if your expenses are going up as I can imagine they are, by doing a horizontal analysis, comparing year to year, then if you see expenses going up, you need to analyze those expenses. And maybe you need to shop around, right? We hear that with insurance and different things like that. You got to shop around for good coverage, but maybe at a lower cost, right? Of course, with both of these vertical and horizontal analysis, if you have more questions or if you want help actually doing this, reach out to your local SBDC. The local SBDCs, we have the resources to know what are the industry averages for all of your businesses. I would have to say, especially if you're a for-profit organization, we should have that, okay? So then we can work with you, gather either your tax returns or your income statements, and we can take that information, put it into a do the financial, do the ratios, or do the percentages that we need, and then compare you to the industry and give you a report that shows you how you're comparing to your industry that you're in. And if you see that your cost of goods sold is really high, then maybe you need to start making some changes to try to bring that down some. One example, to give you an example, a client of mine has found that in his real small restaurant type of business, that it is less money for him to go out and buy grocery type of products from local grocery stores at when they're on sale. And I think in his freezer, or in his basement, he has about 5 or 6 freezers, I think, because he'll buy things on sale and put them in the freezer versus buying it from the big food delivery companies. He said that that's more expensive than going to other stores to buy stuff. And I've seen that even on Facebook. I know another person I'm friends with on there that he goes to Sam's Club and he'll buy a whole pickup truck full of stuff from Sam's Club because it's lower cost than buying it through that big trucking company that brings in like Hertzie and things like that that bring products in. Okay, so we have about 20 minutes left in this training. Before you scoot out on me, afterwards you will receive a survey. We do ask and beg you to please complete that survey for us. It's confidential in the way it comes into our computer system. But the great thing about it is that we will know what you thought of this training, whether you liked it or disliked it, what we can do to improve it. We would love to hear that. And also what other types of trainings that you are interested in. So we do ask that you please complete that as soon as possible. Also, if you are in need of SBDC assistance, reach out to your local SBDC and have a conversation with them by phone, by Zoom, in person, and see if there's anything that we can help you out with, because we would be glad to try to help you. And then also by the end of the week, we will email you these PowerPoint slides via a PDF. And also we should have a recording, because I do believe I clicked record on this. So we should have a recording of this that we can send to you as well, in case you want to look through it again. Other than that, please ask your questions through chat or unmute yourself and ask your question. And then also, otherwise, you are free to go. Thank you so much. I hope you learned something today. Have a great day. And so I'm just going to stick around for a few minutes, see if there's any questions. If no questions come up, then I'll end the meeting here soon. And you are welcome, everybody. I appreciate you saying that. Thank you. So somebody's asking, what is goodwill? So the way I most often see it is when you are purchasing property or purchasing a business, and okay, sorry, I was reading a couple more chats here. So let me ignore that and answer your question. So what is goodwill? If you are purchasing a business and they want $250,000 for it, so you can allocate that $250,000 towards business assets such as building and land and equipment and furniture and fixtures and inventory and supplies. And after you allot a certain amount to it, maybe there's still some left over. Maybe there's like $25,000 left over that you were not able to put a value to it. And so that becomes goodwill. And that goodwill becomes an asset that can be amortized over 15 years, which means you pay $25,000 this year, but you're not going to write it off on your tax return or your accrual-based accounting. You're not going to write it all off this year. You're going to you're gonna take that $15,000, you're gonna, or what I see, $25,000, divide that by 15,000 or $25,000 divided by 15 years. And whatever that calculation comes out to be on a straight line basis, you'll subtract that away as an amortization expense every year on your income statement. It'll show up every year on your income statement for 15 years. That would be goodwill. Accumulated amortization, basically the same as accumulated depreciation. So if you have, let's say we have that, let's see if I can get my pen to work here. If we have that goodwill and it's valued at $25,000, okay? And then let's say we take the $25,000 divided by 15,000. I have no idea how much that is. So I'm going to have accumulated depreciation right here. And it's directly under goodwill. So I might even, thank you very much for giving me that calculation. And so I might even call it accumulated depreciation dash goodwill and dash whatever the asset might be. And then this year, so this is on a balance sheet and that I'm talking about this. And on the balance sheet, this is as of 12/31/22. So this year here, I will have in parentheses a 16 or a negative number, depending on how your bookkeeping is set up. I'm going to round that to 1667. And I should have used, I apologize, I should have used a white sheet here and it would be easier to see. So then and so this is kind of like a subtraction away from goodwill every year. So let's say it's 2023 now, 12/21/2023. This will still be 25,000. This never changes year after year. This never changes. But this number here, the 1667, is going to be over here. It's going to be 1667 times 2, whatever that is, times 2. That's what this result will be. And then this one over here, you're going to add another 1667 to it. So for my sake, I'm just going to do 1667 times 3 to know what that dollar amount would be. But every year, this original 1667 flows forward, but then you have to add another 1667 to it each time. Kind of hard for me to show it, this way without, computer would be so much easier to have a spreadsheet to show you on. But that's what your accumulated amortization. I guess I used depreciation here. I'm sorry. Nobody spoke up for me. It's okay. Accumulated amortization is what this would say instead of accumulated depreciation. Please forgive me for that. Somebody's asking, is there a percent of increase in profit or a number of years of profit stability in business that is considered solid as a basis for loans or making larger business investments? So the one I'll answer, I think I can probably answer, is number of years of profit stability. I think you need to say 3 years on that. I think a business just starting out, like they've only been in business for a year, and then they're going back and asking for another large loan. There may not be enough history there for a bank to feel comfortable giving you that loan. Versus if you had 3 years under your belt and 3 years of good profits under your belt. On the flip side, if you're selling the business, we always say that as well. You want to have at least 3 good profitable years before you sell your business, because a bank for the buyer is going to want to look back on 3 years. Now, a lot of things go into whether a bank will make an investment with you or not. And what I told you is only one factor. There's so many factors. I mean, maybe I will give you a loan in your first year, even though you don't have much history, because maybe that industry is just booming and doing really good. And so it's like, hands down, easy idea to get, or easy choice to give you money. They'll look at your plan, of course, your plan going forward is extremely important. That's where your SBDCs across the state and across the country can help you out with a business plan to show that if you give me this loan so I can buy these assets and grow my business, here is what my projected sales are going to be for the first year, the second year, and the third year going forward. Okay. Now, is there a percentage of increase in profit? I'm not sure I would have an answer for that one. Something that plays into that, though, is in that cash flow statement that we touched upon it. We didn't dive real deep on the cash flow statement, but the cash flow statement, if the SBDC helps you out with it, we'll take your projected cash in, cash out, okay, income and expenses, and we'll build into the cash flow statement your loan that you're asking for. And if your cash flow statement shows a positive cash flow after you make those loan payments for the year, then a bank would have a good reason to give you that loan. Versus if we take your current income and expenses and build in a loan and it shows negative cash flow for the next few years and big negative cash flows for sure, I mean, I'd probably tell you the bank won't even touch you. But I'm not the bank, so don't ever take my thought on that. For sure, you got to go to the bank and let them, tell you that. But I've been doing it for long enough that I think I can guess at what they would do or have a good idea of what they would do. So maybe that answers your question some. Good. Oh, a longer look back. I mean, what we do at our SBDC, we do 3-year projections, and we always ask for 3 years history. So I think 3 years is pretty standard, at least for our lenders in this area. Okay.
Corey, coming from a economic development finance position, yeah, we look at 3 years too when we're looking to partner with banks to do loans.
Great. Thank you for that input. That helps to solidify that. Thank you. Any other questions? So I do believe you have my direct email address if you received the email that I sent out today. Also, I'll be sending out the email of the PowerPoint slides by the end of the week here. So you should have my work email, my personal email. So if you have any questions regarding anything that we talked about here today, please feel free to reach out to me. I would be glad to have a conversation with you. You email me, I'll probably reply back to you with my calendar link that you can click on, and it'll show you my calendar, and you can put yourself right into that calendar spot that you find that works for you. If anyone else here doesn't use it, we use Calendly. It's a great program to use for scheduling. There's also others, of course, as well. Any other questions? Oops. Okay, well then I am going to let you all go. And I wish you the best of luck in all your endeavors. Take care, everyone.